COMEX registered silver just dropped below 76 million ounces as of the 1st of April 2026. If you don't know why that number matters, you're about to. And if you've been watching this channel, hit subscribe, because what we're about to walk through is the kind of structural breakdown that only becomes obvious to most people after it's already over. That number, 76 million ounces of registered silver, represents the metal actually available to back futures contracts on the world's largest silver exchange. The total open interest on those contracts? 115,000 contracts, which translates to roughly 575 million ounces of paper claims. Do that math, and you're looking at a registered leverage ratio of more than 7.5 to 1. 7.5 paper ounces promised for every single real ounce sitting in the vault. And that ratio is not stable. It is accelerating. In the 30 days ending April 1st, 2026, total COMEX silver inventory shed 27.5 million ounces, a decline of nearly 8% in a single month. This is not a market in equilibrium. This is a market running out of the one thing that keeps the entire structure from collapsing: physical metal. The core causal mechanism here is not price manipulation, not speculative frenzy, not even industrial demand in isolation, although that's part of it. The mechanism is the structural decoupling between the paper market and the physical market. COMEX was built on a gentleman's agreement that most futures contracts would never demand delivery. That agreement is breaking down in real time. And when it breaks completely, the price discovery function of the entire silver market breaks with it. Stay with me, because the way this unravels is not what most people think. The registered category on COMEX is not all the silver in the exchange's vaulting system. There's another category called eligible, metal that meets exchange specifications, but whose owner hasn't consented to make it deliverable. Think of it as silver sitting in the warehouse, but with a not for sale tag attached. In February of 2026, even eligible silver started coming out, over 4.5 million ounces left in a single 24-hour period. When both categories drain simultaneously, that's not routine arbitrage or contract roll activity. That's a signal that holders no longer want their metal inside the system at all. They're taking possession. And metal that leaves COMEX vaults, especially metal going to Asia, has historically not come back. The December 2025 event crystallized this. In the first 4 trading days of that month, over 47.5 million ounces of silver were claimed for delivery, more than 60% of total registered inventory at the time, gone in 4 days. COMEX vaults have now drained by more than 73% since 2020. 73%, that number alone should stop you cold. But the financial media isn't talking about it. The Fed isn't talking about it. The CME group, which runs COMEX, certainly isn't flagging it as a crisis. And that silence is itself part of the structural story. So let's build out what's actually driving this, layer by layer, because the surface explanation, industrial demand is rising, is technically correct but structurally incomplete. The first structural force is the industrial demand regime shift. For most of its history, silver was a monetary metal with an industrial side story. That relationship has now completely inverted, and the inversion is permanent. In 2014, solar photovoltaic technology consumed 11% of silver's industrial demand. By 2024, that figure had risen to 29%. And it's still climbing. Solar panels require silver paste to conduct electricity through the cells. You cannot substitute aluminum or copper without meaningful efficiency losses, and in a market where every percentage point of panel efficiency has multi-billion-dollar economic implications, that efficiency premium is not negotiable. The Silver Institute projected solar consumption alone would exceed 230 million ounces by 2026. But here's the part that gets almost no coverage: AI data centers. Every high-performance server connection in a next-generation data center relies on silver-plated connectors to minimize resistance and prevent thermal failure. The 800-volt HVDC architecture increasingly being used in these facilities requires more silver per unit than legacy systems. Global IT power capacity grew 53-fold between 2000 and 2025. That's a 5,252% increase in computing power demand, and every ounce of that growth has a silver requirement embedded in it. Governments have now designated data center infrastructure as strategic national priority, which means demand from this sector is effectively policy mandated and, for practical purposes, price inelastic. You're not going to see Microsoft or Alphabet or the Chinese state slow down AI infrastructure build-out because silver costs more. They'll pay whatever the market charges. The second-order effect most analysts miss: solar and AI are not just two demand sources running in parallel, they are reinforcing each other. AI data centers consume extraordinary amounts of electricity. That electricity demand is accelerating the build-out of solar capacity globally. More solar requires more silver. More AI requires more silver. The two megatrends are feeding the same supply deficit from two directions at once, and the supply side simply cannot respond fast enough. Global mine supply is increasing at roughly 0.3% annually. Industrial demand increased 52% year over year into 2026. Those two numbers, held next to each other, tell you everything about the structural imbalance in this market. The Silver Institute confirmed the silver market is on track for its sixth consecutive year of structural deficit in 2026, with an estimated shortfall of 67 million troy ounces. 67 million ounces of deficit in a year when COMEX registered inventory is sitting below 80 million ounces total. That's not a rounding error. That's an existential constraint. The second structural force is the east-west physical arbitrage drain. This one is operational right now, and it's been systematically dismantling Western vault levels since mid-2025. Shanghai has been trading physical silver at a premium of $4.40 per ounce above New York prices. That spread is a mechanical incentive for any institution with the logistics capability to pull silver out of Western vaults, ship it east, and capture the premium. This is not speculation, this is arithmetic. And the arbitrageurs are doing exactly what the arithmetic demands. The critical second-order effect here is what happens to COMEX-eligible inventory when that drain is occurring simultaneously with futures delivery demand. Eligible silver typically acts as a buffer. When registered inventory gets tight, vault owners can choose to convert their eligible metal to registered status to meet delivery obligations. That conversion mechanism is what has historically kept COMEX from facing a physical crunch during periods of elevated delivery demand. But when eligible silver is simultaneously being withdrawn to capture the Shanghai premium, that buffer evaporates. The pipeline runs dry from both ends at once. The deficiency in net silver moving into the registered category at New York vaults has produced an almost constant depletion rate of roughly 20 million ounces per month. 20 million ounces per month, drained, while the exchange continues to issue paper promises at many multiples of what it can physically back. The geographic concentration of what remains makes this worse. Approximately 75% of total registered COMEX inventory sits in New York area warehouses. Single point of failure risk is not an abstract theoretical. It's a logistical reality. If access to those facilities is disrupted for any reason, or if a concentrated wave of delivery requests hits in a single contract cycle, the math stops working immediately. The third structural force is the paper market leverage trap, and this is where the mechanics get genuinely dangerous in a systemic sense. COMEX operates on the assumption, embedded in its entire clearing and settlement architecture, that the vast majority of futures contract holders will roll their positions rather than demand delivery. Historically, delivery rates were low enough that the exchange could maintain leverage ratios that would be considered reckless in any other asset class. As of the analysis period in early 2026, open interest on silver futures stood at 429 million ounces against registered physical inventory of approximately 103 million ounces, a coverage ratio of 24% compared to historical norms of 15 to 20%. That deterioration sounds modest until you understand the nonlinear dynamics at play. When delivery demand starts rising, and it has been rising, each successful delivery further depletes registered inventory, which tightens the coverage ratio, which signals to other large holders that they should also demand delivery before inventory runs out, which depletes inventory further. This is a self-reinforcing feedback loop. It doesn't require a coordinated conspiracy. It just requires rational self-interest operating within a system where everyone can read the same warehouse reports. If even 20% of open interest converts to physical delivery demand, COMEX cannot fulfill it. That's not a black swan. That's basic division. 82 to 113 million ounces of deliverable stock against 425 to 455 million ounces of paper short positions. The optimistic leverage estimate is 5 to 1, and in specific contract cycles it has reached structural ratios that no exchange should be permitted to operate under. The third order effect that almost nobody is modeling correctly is the credibility contagion risk. Silver and gold share the same institutional infrastructure. They share the same vault operators, the same clearing mechanisms, the same counterparty relationships. Analysts who track this market closely have made an observation that deserves to be taken seriously. A COMEX silver delivery failure would likely spread to gold within 24 hours. Not because gold has the same physical shortage dynamic, and it doesn't, but because a failure on silver would trigger a fundamental reassessment of whether any paper metals claim can be trusted. The credibility of the entire complex depends on the exchange honoring its obligations. One failure cascades. Now, where does this leave us in terms of the forward trajectory? Because the causal chain we've just walked through points in one direction with very little structural ambiguity. The mainstream narrative on silver, to the extent it exists, frames this as a speculative retail moment. The Reddit crowd and the gold bugs making noise, prices elevated, but nothing systemic. That framing is not just incomplete, it is structurally dishonest. The inventory data is public, the leverage ratios are public, the Silver Institute's deficit figures are public. This is not hidden information. It's information that doesn't fit the narrative that derivatives markets are well functioning, that paper claims are as good as physical metal, and that central banks and exchanges have everything under control. They don't. And the data shows exactly why. Silver rallied roughly 130% over the prior year as of early 2026. The solar industry is now actively trying to engineer silver out of their supply chains because the price has become a margin problem. But here's what substitution actually means in practice for this market. The research and development cycle to meaningfully reduce silver content in solar cells takes years, not months. Even optimistic substitution timelines run to the end of this decade. Meanwhile, AI infrastructure build-out is accelerating in real time, not slowing. And physical delivery demand on COMEX is not declining. It's the directional trend that keeps asserting itself regardless of what paper prices do in the short run. Policymakers face a genuinely impossible set of options here. If prices rise to reflect genuine physical scarcity, industrial users face input cost crises, and the solar energy transition gets more expensive, which is politically unacceptable to governments that have staked their climate credibility on solar deployment. If the exchange attempts to suppress prices through paper mechanisms, it accelerates the physical drain because buyers who understand the structure will simply demand delivery at suppressed prices, extracting real metal at below market rates. There's no policy lever that resolves this without acknowledging the underlying imbalance. And acknowledging the imbalance means acknowledging that the paper market is not accurately pricing the physical market, which is an admission no exchange has ever voluntarily made. The logical endpoint of the current trajectory is a forced convergence. Either the paper price rises to reflect genuine physical scarcity, and the leverage ratio normalizes through price discovery, painful but orderly, or the leverage ratio normalizes through a delivery failure, which is disorderly, rapid, and structurally damaging to every paper metals market simultaneously. You are watching that convergence begin. The 30-day inventory decline of 27.5 million ounces as of April 1st, 2026, hitting a one-year low. The registered leverage ratio at 7.5 to 1. The sixth consecutive annual deficit confirmed. The physical premium in Shanghai that makes draining Western vaults the rational trade every single day. These are not disconnected data points. They are sequential steps in the same structural process. The positioning insight that follows from this analysis is not complicated. When physical commodity exchanges operate at leverage ratios that cannot survive even moderate increases in delivery demand, the risk is not that prices might rise, it's that the mechanism for price discovery itself might break. Markets can absorb price moves, even violent ones. What they cannot absorb cleanly is a foundational loss of confidence in whether paper contracts represent real claims. That kind of crisis reprices not just silver, but the entire architecture of institutional trust in derivatives markets. The people who understand this are not debating it on financial television. They've already moved to take possession of physical metal. The vault data confirms it. 73% of COMEX silver inventory drained since 2020. That metal went somewhere. It didn't evaporate. It's in the hands of people who decided that a paper claim wasn't good enough, and a receipt in a vault they don't control wasn't good enough either. Think about that for a moment. In a world where the financial system runs entirely on trusted intermediaries, banks, exchanges, clearinghouses, the people who track physical commodity flows most closely are the ones who've decided to step outside that system entirely when it comes to silver. That's not paranoia. That's a rational response to a structural reality that the leverage data makes impossible to deny. The final question worth sitting with is this. If COMEX cannot deliver silver at current prices, what does it actually mean for an exchange to set the price of silver at all?